Hello, friends. Let's talk briefly today about the bandwagon effect in the stock market. This is an important effect that's the outcome of the cognitive bias. And I would like to discuss this with you. So I will go ahead and share my screen here. One second. Okay, so bandwagon effect. What's that? And first, we'll start with the usual disclaimer. There is no investment advice in this video, and no advice to buy anything or any security or anything else. Okay, so let's go to the next slide, and this is the definition of the bandwagon effect from Google Generative AI. The bandwagon effect is a psychological phenomenon where people do something because others are doing it. Sounds familiar, of course. It's a cognitive bias that can be caused by a variety of factors, including, let's focus on the first factor, the social factor. People may want to be part of a group that seems likely to win. Again, that sounds familiar. This is what people want to do in the markets. They want to invest and win. And this is the cause of this cognitive bias. I'd just like to clarify before we continue that not all cognitive biases are bad. Some have been very helpful in the evolution of humans and have provided protection and conditions for the evolution. So some cognitive biases may be bad under some conditions, and they may also be good under some other conditions. The bandwagon effect in the market is self-reinforcing. Sounds familiar? This is the definition basically of reflexivity. And it becomes stronger as more people join. This is exactly what happens with reflexivity in the stock market. It can be observed in many areas, including financial markets, where people invest in particular asset because it seems to be popular. So this is what Google Generative AI, how it described the bandwagon effect. I think the description was so good. So let's continue. This is a chart of the S&P 500 index from early 90s to present, as of the end of last week, actually. And here we have some blue arrows and red arrows. The blue arrows are when we had excess reflexivity in the markets. What do I mean by this? In the late 90s and after the ruble crisis in August of 1998, there was again a strong rally to new all-time highs, and even the Fed chairman at that time called this irrational exuberance. And people thought that stocks will continue to go up for many, many years, but then something happened. Now, remember these words, something happened, because something always happens. And reflexive rallies and the bandwagon effect, they end in tears. And this happened in 2000. Also, I remind you that in the late 1990s, there was an effort to balance the budget, and they actually succeeded. And that was a contributing factor to the uh, development of the bear market that lasted for about 2.5 years. And many people lost fortunes in this 50% decline. And then the government, they started the deficit spending again, and stocks rebounded, and then slowly they tried to recapture the 2000 top, but then something happened again. This was the second stage of a bandwagon effect. Since the early 90s. At that time, people thought that the worst was over and markets will continue going up. But due to the real estate crisis and the bubble in the financial sector, something happened again. And we had a very powerful crash, and this time was faster than in the dot-com. And this was about 55% if we exclude dividends in the S&P 500 index. And again, many people lost fortunes. The problem with the bandwagon effect, when many people join this idea of the market uptrend will continue for a long time, is that something always happens and there is a crash. And then these accounts that are known on social media, they come and they tell you, oh, the stocks always go up. You should never sell. But although we know that stocks always go up, when stocks are down like 30%, people panic. So after the dot-com, markets went up, but many of the old investors were not part of the move. And there were new investors. And after the financial crisis bear market, again, the markets rebounded, but many of the old investors were not part of the new rally. There were new investors joined, and mainly institutions. And the idea that you can weather these large corrections in the market is naive. Because in hindsight, you say, oh, I should have stayed invested in the market here as they went up. But let's say you were here in late 2008. You don't know whether it's going to be a V bottom or markets will continue to go sideways for 10, 15 years. For example, emerging markets moved sideways from 2011 to about 2019 or 18 for many years. Now, the central bank in the US has been instrumental and successful in engineering these V bottoms. Here we see it in 2002, 2009, March 2009, and then during the pandemic crash and during the 2022 bear market. But for how long? Let's see what happened by the end of 2019. Again, you had these big accounts on social media after the new all-time highs, after the 2018 correction. They said, oh, markets will go up for many, many years, and then something happened. And what happens is most of the times unexpected or expected, but we don't know the timing. So a pandemic happened. And then again, people got panic and they sold. And the government came in, they started printing money and deficit spending. And then when we got to new highs in 2021, again, the same accounts, uh, very popular, many, many followers, hundreds of thousands. They said you should have stayed in the market. Of course, this is hindsight. So the market continued to rise until the end of 2019, and everyone thought this is it. It's a long-term uptrend, and then something happened. What happened? Inflation went out of control due to the money printing, and the supply shock from the uh, pandemic, and also wars in Europe. And then we had this bear market, and it was one of the worst because both stocks and bonds went down. And also for traders, it was a pain trade because it was very hard to short equities due to the reflex rallies. And then the government, of course, they promised in October of 2022 that they will lower rates, which they did only recently, but the market likes promises. And now we are at new all-time highs. And the same accounts are all over the place. And they say, look, this is going up. It's going to be many, many years of uptrend. And we know that. We know that. Anyone who is forecasting gains in the stock market is what I call a charlatan. Why? Because yearly returns in the stock market are almost normally distributed. Success rate of 72.4 for an up year and about 2.6 to 1 odds of an up year. So if you tell me that the next year the market will go up, you are not forecasting. And if you claim you are forecasting, you are a charlatan. Because this is not a matter of forecasting. Forecasting in the markets has value if you can predict when the next bear market or crash will happen. But this is very difficult because of the unpredictability of these events. So, in other words, forecasting in the market is a futile exercise. Those who claim the market will go up actually are not forecasting. They are basically confirming what the market has been doing for decades. And those who say it will fall, some of those, they say it all the time, they are usually wrong because the timing of the fall is not predictable. So you have charlatans all over the place, and we don't know when the market will fall next time. We are here in another bandwagon effect, reflexivity fueled by narratives about AI. Some are true and some are falls and also expectations of continuing earnings and rising GDP, those may or may not be correct, but always remember, always something happens. And this may be 1 year, 2 years, 5 years, or even tomorrow. And the question is, how do you protect yourself and your portfolio, of course, from something bad happening? There are many ways to do it. You have to ask your certified financial advisor. There is diversification, there is tail risk hedging, investing in alternatives, leaving some money in cash, buying gold, etc. But do not rely on naive allocation schemes presented on social media or in the blogosphere or in articles with hindsight bias. An example was the all-weather portfolio that worked extremely well until 2021, and then due to high allocation to stocks and bonds, crashed in 2022. So do not rely on what happened in the past. Always the next adverse scenario will be probably not what happened before, like what happened in 2022 with bonds and stocks going down together. Very few people expected that. I wrote an article on Seeking Alpha with the title, The 60/40 Portfolio is a risky investment, and people jumped on me. And they were telling me, no, it's not a risky investment, it's a sure thing. But the problem is all these people disappear when the market is under stress. The perma bulls disappear, the perma bears disappear when they are new all-time highs, and the perma bulls disappear, and they always appear, the perma bulls, when there are new highs, to tell you that yes, we were right. We were right. See here, new all-time highs. Of course, that's a charlatan, because the problem is what do you do when there are those unexpected events, the red arrows? What do you do? What do you do when stocks are falling 30% to 35%? Do you stay in? Do you buy more? Do you sell a little and wait to average down later? Or what do you do? There is no generic formula. It depends on the risk aversion profile of every investor and what they can sustain psychologically. So I wouldn't listen to anyone, but only to someone who is certified financial advisor and knows this business well. For instance, I'm not certified, so do not listen to me. I'm just referring to the problem of what is happening here. So we talked about the odds. I talked about the bandwagon effect in this week's weekly market report for premium subscribers, but the first two sections have free access. And if you go to the blog, the Price Action Lab blog, you can find the weekly market report and read about it, read about the bandwagon effect. and about some other things about the market. So this is it for today. Thank you for listening. Have a nice day.